Why Taiwan Semiconductor stock will go to $200 a share by 2030. Taiwan Semiconductor is trading right around $467 a share as this is being written, fresh off a 52-week high near $477 and carrying a market capitalization of roughly $1,097 trillion. That's already an enormous run from its 52-week low near $214. Meaning the stock has more than doubled in the span of a year. So when someone suggests TSMC could climb all the way to $200 a share by 2030, that sounds like a stretch on the surface, roughly a 150% move on top of a stock that's already had a historic run. But once you understand exactly what TSMC actually is in the global economy right now, not just a chip company, but the single most irreplaceable company in the entire AI supply chain, $200 starts to look less like a moonshot and more like a logical destination for a business that the whole world depends on and literally cannot route around. The single most important fact about TSMC is one that doesn't get repeated enough. This is the company that manufactures roughly 70% of the world's chips and an even more dominant share of the most advanced ones. Every cutting-edge AI chip from NVIDIA, every custom silicon design from Apple, every advanced chip from AMD eventually has to pass through a TSMC fab to actually become a physical product. NVIDIA doesn't manufacture its own chips. Apple doesn't manufacture its own chips. Almost nobody in the fabless chip design world manufactures their own chips because TSMC's process technology is simply that far ahead of the competition. That's not a temporary advantage built on one good product cycle. It's a structural moat built over decades of capital investment that's extraordinarily difficult and expensive for any rival to replicate. That structural dominance shows up directly in the financials. TSMC's most recent annual revenue came in at 3.81 trillion new Taiwan dollars, up more than 31% from the year before, while earnings grew even faster, climbing over 46% year over year. Margins remain extraordinary for a manufacturing business, with gross margins above 60% and net margins approaching half of revenue. Numbers that look more like a software company than a heavy industrial manufacturer. That combination, explosive growth paired with software-like margins, is exactly the kind of profile that justifies a premium valuation and gives long-term investors confidence that today's growth rate isn't a one-time AI-fueled spike. It's the new baseline for how this business operates. The demand side of this story is, if anything, getting more intense rather than less. Reports indicate that AI chip demand is now straining TSMC's capacity so much that customers like AMD, Google, and even Tesla have started exploring Samsung's foundry as a backup option, simply because TSMC can't make enough advanced chips fast enough to satisfy everyone who wants them. That's an unusual problem to have, and it's a bullish one. A company that's capacity constrained rather than demand constrained has enormous pricing power. And TSMC has historically used exactly that kind of leverage to push through price increases on its most advanced nodes without losing customers, because there's simply nowhere else for those customers to go for the same quality at the same scale. Wall Street is already adjusting its expectations upward in real time. Susquehanna recently raised its price target on TSMC to $575 from $500, and the broader average analyst target sits around $473, with the most bullish estimate on the street reaching as high as $700. Those are 12-month targets, not 2030 targets. And the fact that analysts are still raising numbers after the stock has already doubled over the past year tells you the market hasn't finished digesting how central TSMC has become to the entire AI build-out. If TSMC keeps compounding revenue and earnings at anywhere close to its recent 30 to 45% growth rates for even another 3 or 4 years, a $200 share price by 2030 stops requiring a multiple expansion miracle and starts looking like a fairly ordinary extension of the growth curve the company is already on. None of this means the path is risk-free. TSMC remains a Taiwan-based company. and Taiwan's geopolitical position between the United States and China is the single biggest risk sitting over this entire investment thesis. Full stop. Any escalation in cross-strait tensions would hit TSMC's stock harder and faster than almost any business risk a normal company has to deal with. There's also genuine technological competition emerging, with Samsung absorbing overflow demand and Intel's foundry business showing real signs of a turnaround, including a reported chip-making agreement with Apple. Morningstar has pointed out that TSMC currently trades at a meaningful premium to its estimate of fair value, which is a fair warning that a lot of optimism is already priced into the stock today. Even with those risks on the table, the core thesis holds up. TSMC isn't just participating in the AI boom. It's the foundation everyone else's AI boom is physically built on top of. And that kind of irreplaceable position in the global technology supply chain is exactly what allows a stock to keep compounding year after year, even after it's already had a massive run. Get from $467 to $1,200 by 2030. And you're talking about a company that simply kept doing what it's already doing, a little more, for a few more years, while the rest of the world remained completely unable to build the chips of tomorrow without it.